Thank you again for joining us today. Again, my name is Anna Fiorentino, and some of you may be familiar with me from my work in the Fund Advisor Plus publication. Today, as was mentioned, I'm being joined by my colleagues, Mr. Curtis Clark and Mr. Peter Healy. This afternoon, we are going to provide an update on the market and economy, then review this month's recommendation for one fund to buy right now. To cap us off, my colleagues, Mr. Clark and Mr. Healy, will answer some questions submitted directly from our viewers. It stands mentioning that within the next several business days, this presentation will be available on our website and on our YouTube channel, alongside our full catalog of historical webinar recordings and how-to videos for our screens and other database tools. Before getting started, for those of you joining us for the first time, we wanted to extend a special welcome and provide a brief overview of our organization. Value Line is a New York headquartered corporation that has been providing trusted investment research for more than 90 years. Many are familiar with us through our flagship product, the Value Line Investment Survey, that comes in its signature green library binding, proudly gracing many prestigious and elite office shelves over the decades since our founding. While time and technology change all things, we recognize that different readers have different preferences for their research process. This weekly publication continues to be available both in print and digital format as a feature of our long-standing white glove service. All of our publications offer a unique source of information designed to help investors make informed decisions that fit their individual financial goals and risk tolerances. Our remarkably comprehensive suite of products includes data and analysis on equities and funds that trade on the New York Stock Exchange, NASDAQ, and Toronto Stock Exchange. They also include thoughtful economic commentary, easy-to-follow model portfolios, a variety of stock screens, industry-based analysis, and so much more. Each service is thoughtfully crafted by our uniquely human Value Line research department. This robust team is comprised of nearly 70 analysts, economists, statisticians, and quantitative specialists. One thing we like to drive home is that regardless of which publication you read, our research is reliably unbiased and independent. Unlike many Wall Street brokerage firms, Value Line intentionally has no direct affiliation with the investment banking business, including all the equities under our coverage. Value Line does not execute trades for its subscribers and continues to maintain no vested interest in any given entity. We can proudly provide insights and expert opinions free from influence on whether our subscribers buy, sell, or hold a specific equity. What's more, as a part of our universal compliance protocols, our staff of professional securities analysts are not permitted to own any shares of a company, ETF, or mutual fund they cover. If you have any questions about the products or services we offer, or about our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE during regular business hours for help from one of our U.S.-based representatives. Now, moving right along, we like to begin our webinars with recent insights from our team of economists on the market and broader economy. This most recent edition comes from our August 29th issue of the Value Line Investment Survey and can be found each week inside of the section appropriately titled Selection and Opinion. The July price data painted a mixed picture on inflation. On the positive side, the Consumer Price Index, or CPI, was relatively in line with the consensus forecast and overall benign. Conversely, the Producer Price Index, or PPI, came in very hot, with the PPI and core PPI, which excludes the food and energy components, jumping 0.9 and 0.6% respectively on a month-to-month basis, suggesting that the Trump tariffs may be leading to an uptick in inflation at the wholesale level. However, it should be noted that the PPI tends to be a more volatile series of data, and a good deal of the July PPI increase came from the services side, which is little impacted by tariffs. The labor market is holding up well. True, the nation created an estimated 73,000 jobs in July, well below the consensus forecast of 110,000. However, the unemployment rate held steady at 4.2%, a level indicative of near full employment, and we've not seen a notable uptick in corporate layoffs. In fact, initial weekly jobless claims in early August remained at a pace typically associated with the tight labor market. According to the Fed futures market, the odds of an interest rate cut in September remain high. However, the overheated July PPI figure, which factors into the personal consumption expenditures PCE price index reading, likely takes the possibility of a half-point reduction off the table. It also might make the central bank less dovish on the monetary policy front over the remainder of 2025. Still, the stock market is encouraged that the Federal Reserve appears set to cut the federal fund rate by a quarter point next month. A favorable second quarter profit performance was cheered by Wall Street. Indeed, earnings growth for the S&P 500 companies was averaging nearly 12% for the period, easily exceeding prognostications. The new tariffs did not have as much of a negative impact on second quarter results as feared, but still may prove to be a headwind for business in the months ahead. In conclusion, given the strong second quarter profit performance from corporate America and sentiment that the Fed will resume cutting rates next month, a portfolio led by high-quality stocks is recommended, despite valuations looking a bit frothy. Again, that piece was brought to us by the Value Line Economist team and is available each week in the Selection and Opinion segment of your investment survey. Before we move into the Fund Advisor section of our presentation, beginning earlier in 2025, we began introducing the new Value Line digital booklet for two key publications, the Investment Survey and our Small and Mid-Cap service. In the coming year, both the Value Line 600 and Fund Advisor Plus are anticipated to join our library of interactive booklet offerings. This format offers powerful, user-friendly tools alongside a faithful digital reproduction of the original print edition. To access the digital booklet version of a publication, I will head to the dashboard and click my preferred title on the right-hand side. This can be found underneath the heading Traditional Online Access. Today we will look at the Small Mid-Cap edition. On the landing page, digital booklets for both the current and back issues can be accessed, as well as the usual PDF format. Let's open our most recent edition of the Small Mid-Cap for a brief look. Once into the booklet, navigation is as easy as flipping the page or jumping to a specific bookmark using the sidebar, conveniently organized by industry. You can now also take notes right within the booklet, saving comments or points of interest for yourself to review again later. Now back to our topic at hand this afternoon, the Value Line Fund Advisor Plus. This long-standing publication is available in both print and digital formats and is committed to providing readers with all of the information they need to develop and maintain a well-constructed portfolio of mutual funds. For those unfamiliar with the inner workings of a mutual fund, it essentially represents a like-minded collective of investors who have pooled capital and jointly hired financial professionals to manage and make investment decisions on behalf of the group. Why is this beneficial or helpful? Well, owning individual stocks may be cost prohibitive or too involved and time sensitive a process for some investors. Individual holdings may also create too much exposure to a specific company or industry, or conversely, not enough. In a mutual fund or ETF, investments are spread over a variety of securities, including equities, fixed income, and even cash, towards the fund's stated objectives. Importantly, mutual funds are tightly regulated by the U.S. government, explicitly in the interest of protecting their investors. These regulations provide more investor safeguards than for any other type of investment. Managers are typically extremely seasoned financial professionals and often carry the prestigious designation of CFA. As a result, the mutual fund industry has built a solid reputation that has helped to build and maintain popularity the world over. If you would like to learn a bit more about how mutual funds work, please submit your questions in the chat for our Q&A session, or visit our carefully crafted investor education guide, which serves as a starting point for our investors, providing broad information on assessment of objective groups, understanding risk, and guidance on evaluating a variety of funds to find what fits you. Since this is an opportunity not only to tell but also to show, let's review how our mutual fund commentaries, screens, and monthly digital issues through your subscriber portal can be found. First, head to your dashboard and click on the Fund Advisor Plus button, which I have already done here. As you can see, the Fund Advisor Plus is still published digitally on a monthly basis and is now accompanied by a new, more comprehensive quarterly print edition as of this June. Each issue of the Fund Advisor Plus is composed of two sections: statistical data and featured articles, or highlighted funds. We suggest that subscribers visit this page on a monthly basis to access our most current insights and data on the Value Line Fund universe. Each issue of the Fund Advisor Plus includes an overview of the economy and detailed statistics, graphs, performance data, and more on 3 carefully selected funds we think investors should consider owning. Included in every issue, Value Line recommends funds for each of the 10 major fund categories listed in our product guide. We group these funds by level of risk, assigning 3 funds to each of the risk designations, including high risk, moderate risk, or low risk. Fund Advisor Plus also includes 4 model fund portfolios. 2 of them feature mutual funds and 2 feature exchange-traded funds. These model portfolios are designed to help investors choose the best fund by following Value Line's recommendations. Now let's move on to the fund to buy right now. For this, let's go to our first screener. To find your screener tool, click on the green tab located at the top of the Fund Advisor page. Value Line subscribers have access to several dozen preset screens and even more specific fields for detailed winnowing. As noted in our economic commentary, tariffs continue to be at the forefront of economic policy discussions of late, causing moderate but not overwhelming uncertainty in the domestic market. Accordingly, today we're going to be looking for stable, low to moderate risk funds that are well positioned to keep pace with or even possibly outperform the market at large. Our funds are ranked from 1 to 5, with 1 being the highest overall rank, the best risk-adjusted performance, and the best risk rank, the least risky. Our team calculates overall rank on the basis of 3 critical factors: 5 and 1-year persistence of relative growth and fund returns, and 3-year risk-adjusted performance. Growth persistence is a proprietary Value Line measure that rewards funds for consistency in outperforming their broader peer group universe. Risk ranks are calculated for each of 2 broad categories: equity and partial equity funds, and taxable and tax-exempt fixed income funds. The ranks are based on standard deviation, a measure of a fund's volatility. At Value Line, we specifically use a 3-year period for this calculation, which provides enough data for reliable measurement without overweighting data with content that is likely too old to be relevant at this point. Again, for more information, we encourage you to enter your questions in the chat or to peruse our Fund Advisor Ranking System Guide, which is available free of charge from within the investment education section of our website. Today, we're going to focus on a fund with an overall rank of 1. As you can see, I'm on the top criteria section of our screens. I will select 1 and hit Add. Next, we're going to filter for risk rank. Today, we're looking for stocks ranked 2 or better for risk. Investors should typically wish to outright avoid funds that rank as 4 or 5, while stocks ranked 1 and 2 are considered above average for either category. Applying both filters, we're now down to 745 candidates. Today, we want a stock with strong momentum, so we'll be looking at issues that have generated a total return of at least 10% over the past year. We can find this underneath the Performance tab. Note that you have the option to select specifically equal to, less than or equal to, or greater than or equal to. I'm going to select greater than or equal to 10%. With that filter applied, our list is now narrowed down to 443 candidates. Next, I'm going to jump down to shareholder information. We also want a fund that is affordable to start investing in. An average minimum to invest might fall anywhere between $500 to several thousand. But since we are looking for a more conservative intro, let's have it and enter in $250 or less. Applying that filter, we find ourselves down to just 255 candidates. Next, we're going to go to fees and expenses. Seasoned investors will know that all mutual funds have what is called an expense ratio. This refers to an annual operating fee that directly corresponds to the fund's assets. This would include covering the cost of compensating management, bookkeeping, and even marketing efforts. As such, it is in an investor's interest to find a fund with a lower expense ratio without sacrificing overall performance. Typically, somewhere between 0.75% and 0.5% is most desirable. In keeping with this, we are going to split the difference and filter for less than or equal to 0.625%. Let's stay with the affordability theme and set this filter here for no load. No load simply means no commission is charged either at the time of purchase or at eventual sale. With those two filters added, we are now down to just 168 candidates. Next, we're going to visit portfolio composition. The all-important portfolio composition dictates how much exposure investors have to a particular class of security, industry, or even country. This matters all of the time, but in consideration of our goal for today of low to moderate risk, let's look for a more staid balance of stocks, less than or equal to 75%. And a meaningful presence of bonds greater than or equal to 25%. The addition of this criteria now leaves us with only 11 candidates. Next, we'll visit description. To build off of that last set of criteria and to cap off our search, let's also set a preference for fund objective. To minimize outsized exposure to any one industry or sector, we're going to say we want allocation balanced. A balanced allocation can refer to several moving parts, including the ratio of stocks to bonds or growth versus value stocks, but the objective remains the same. Provide investors with a sound mix of stability and upward mobility, typically over a long-term time horizon. This final filter leaves us with just 7 candidates. Let's hit run. Looking at these final 7 candidates, as you might expect, one could make a case for any of the remaining funds. However, only one can be today's one fund to buy right now. After consulting with our mutual fund analytics team, we prefer and recommend American Funds Balanced F1, ticker symbol BALFX. This is a share class of American balanced funds that is available to the self-directed retail investor. When I click on the highlighted icon for the ticker symbol, this takes me directly to the page for this particular fund. Please note that screens can be saved and revisited by utilizing the export buttons located at the top of our list just here. Incepted in July 1975 and overseen by Capital Research and Management Company, this fund seeks to provide three important benefits to its investors: conservation of capital, current income, and long-term growth of capital and income. The management for the fund is facilitated by 12 portfolio managers from Capital Group with an eye towards diversified specializations across the team. Together, they aim to achieve that three-pronged objective through a balanced approach and is managed as if it constituted the complete investment program of the prudent investor. As we already know from our filter, this fund does not invest more than 75% of assets in common stocks, and all of the fund's fixed income investments are investment grade at the time of purchase. Dividends are distributed quarterly in February, May, August, and December. Capital gains are distributed in February and December. The American Balanced Fund, Class F1 shares, ticker symbol BALFX, is today's one fund to buy right now. I will now hand the microphone over to my colleague, Pete Healy, who will now tackle your questions. Please note that we typically can't answer complex queries about specific funds on the spot. For this, we recommend a review of our latest reports. It looks like our first few questions were submitted prior to this presentation. Go ahead and take it away, Pete.
Thank you very much, Anna. The first question refers to our one fund to buy right now. Is the fund you're recommending available as an ETF? No, not as a separate share class the way Vanguard provides some of their ETFs. However, Capital Group, owner of the American funds, does have an ETF similar to this fund. It's the Capital Group Core Balanced ETF. Ticker is CGBL, Charlie, George, Billy, Larry. ETFs, of course, have grown in popularity in recent years due to their tax efficiency and ease of trading. They were mainly just index-oriented in their early days, mostly mimicking a benchmark. Now, of course, there are more active ETFs than ever, like the aforementioned Capital Core Balanced ETF. Okay. Next question. As a long-term investor, what signals should one pay its close attention to when evaluating when is the optimal time to sell? All right, there's two main signals I would say look for. Number one is a change in the portfolio manager. That would be the first important one. And I'm referring to the primary manager here, not a case where there are, say, 12 managers like Anna just mentioned for this fund, and one who's been there for 2 years just all of a sudden up and leaves. Change in a key manager could mean differences in security selection, which might have an adverse effect on the performance. All right. Usually shareholders receive fair warning, though, if a manager is leaving, retiring, and such, sometimes between 12 and 18 months. The second factor I would say is underperformance. This is a long-term investment. However, I'd say if you hit 2 years where the fund has underperformed versus its benchmark, then the fund's strategy and direction is not matching up with the market anymore. Next question. Are there less mutual funds available now than there were 5 or 10 years ago? Yes, there are. One of the primary reasons is consolidation within the asset management industry. Recently this year, for example, the Victory funds purchased the Pioneer Fund family. We also had a year or so back the Franklin funds acquiring both Putnam and the Legg Mason funds. This has all led to similar funds within families being merged or liquidated, where they stop trading and thus lessening the number of funds available. Okay. All right, next question. I'm 45 years old. How can I identify a good fund for retirement? Well, I'd say target date funds probably make the most sense in this case. You can screen on the target date objective on the fund advisor screener and then hone it down based on other variables you consider important, such as the expense ratio. In this case, if you're going to retire, say at the age of 65, 20 years from now, a target date fund from 2045 would be probably your best option. All right. Next question. Do sector funds represent a good investment? They can, but timing's very important consideration. Getting in after a big run-up is generally not a good idea. Finding a fund in this manner with a portfolio manager that beats his peers is probably the best thing to look for. I must note, though, that sector funds can be very volatile, and of course, and that makes them very risky. Okay, a conservative investor should probably avoid these types of funds. That looks like all the questions we have.
Well, thank you, Peter, and thank you, Anna. Thank you, everyone, for our remote attendees for joining today's webinar. This does conclude today's event. You may now disconnect your lines and have a great day.